Hey everyone, and welcome to today's edition of Noisemaker, where we'll be talking about two interesting companies that are quietly making big moves in their industries. The first company is a tech solution firm that just secured a massive 224 crores defense order from the Indian Army, and the second company is a leading agri equipment maker that just launched a new compact tractor range under the FENTM brand, specifically designed for small and mid-sized farms. So basically, both the companies are expanding steadily, one through large defense orders and ecosystem building, and the other one through product innovation, rural market expansion, and global ambitions. I'm Saizal Agarwal, Equity Research Analyst at Desvelado Advisory, and today we'll be talking about two companies that are making solid progress in their business, and if current trends continue, they might keep growing even further. But before that, let's have a quick look at the disclaimer. So any discussion, facts or writings provided here are for informational purposes only and do not constitute any buy or sell recommendation. So please conduct your own due diligence before making any investment decision. Now let's move to the first company, AXISCADES Technologies Ltd, which is a tech solution provider that's slowly but steadily transforming into a serious indigenous defense player. Through its subsidiary AXISCADES Aerospace Technologies Pvt Ltd, the company bagged a massive 223.9 crores order from the Indian Army to supply 212 next-gen 50-ton tank transporter trailers. And this is under the Atmanirbhar Bharat initiative, and more importantly, it marks a strategic shift from being just an engineering services player to becoming a full-fledged defense manufacturer. This single order alone is expected to contribute meaningfully towards AXISCADE's ambitious goal of growing towards defense revenue by 75% in FY26. Plus, it strengthens their defense order book, which already includes major programs like LCA, Sukhoi, AWACS, and counter drone system. So now Mudit will be joining in to take us deeper into how this order fits into the larger growth puzzle. So Mudit, how do you view AXISCADE's evolution across defense and aerospace, especially with the kind of projections they are giving for FY26?
Thanks, Cecil. Honestly, what's impressive is how they've started to build a strong dual engine growth story. Defense on one side and aerospace on the other. On the aerospace front, they're targeting $51 million in revenue in FY26, which is a solid 35% year-on-year growth, largely backed by repeat work from giants like Airbus. Then you've got the ESAI, that is Engineering Solutions and Advanced Integration segment, which is also expected to grow by 60% thanks to 600 plus crore qualified pipeline. What this tells me is they are no longer just a vendor, they are slowly embedding themselves across the entire defense aerospace value chain. That brings better operating leverage, scope for margin expansion, and more consistent revenue visibility. But Cecil, what's your take on their FY25 revenue and whether it sets a strong base for this upcoming leap?
Great question, Mudit. I think FY25 was a solid year that gives them the right launch pad. The revenue from operation grew 7.9% year on year from 955 crores in FY24 to 1030 crores in FY25. And quarterly revenues were also stable, 274.5 crores in Q4 and 267.9 crores in Q1 FY26, which shows execution consistency. EBITDA also came in at 163.1 crores with margins improving slightly to 15.8%. But what stood out was the net profit of the company, which more than doubled to 75.2 crores from 33.4 crores, mostly due to margin recovery in Q4 and Q1 FY26. Also, their Q1 FY26 net profit margin at 11.6%, which shows better cost control and execution efficiency. So, overall, yes, the base looks solid, but now I'm curious with such aggressive growth plans, how are they backing this up with infrastructure? So, Mudit, what's the story on the Capex and long term planning side?
That's actually the most exciting part, Cecil. They have kicked off phase 1A of their Devanahalli Atmanirbhar complex with a 120 crores investment. This phase will focus on building systems around radar, electronic warfare, and aerospace, with operations expected to begin by Jan 2026. Then phase 1B will add things like tool rooms and inspection areas. The idea is to bring more production in-house to better control costs and improve margins. And then there's a second big push, the missile Atmanirbhar complex in Hyderabad. It's a 6-acre facility focused on missile assembly, subsystems, warheads, and guidance units. This is a strategic bet. It not only taps into the fast growing missile segment but also opens up future optionality in unmanned systems and precision strike tech. Both these projects fall under their long term Power 930 strategy, where they are targeting 9,000 crores in revenue and 24% EBITDA margin by FY30. Also, I think while the runway is huge, execution is key here. The biggest risk in delays is project commissioning, especially DAC and MAC, because time execution will determine whether the growth flows in as expected. Also, the dependency on defense orders means lumpiness could come into play. So, diversification across civil, aerospace, or exports would help.
Okay, thank you, Mudit. So now let's move to the second company, VST Tillers Tractors Ltd, which is one of India's oldest and most trusted names in the farm merchandisation. Founded in 1967, VST began as a joint venture with Mitsubishi Heavy Industries and has since become India's largest manufacturer of power tillers. But now they are shifting gears and targeting the next stage of growth through compact tractors, electrification, and exports. Most recently, the company launched its FENTM Tractor Series, introducing 5 models in the 18.5 to 29 HP range, available both in 2WD and 4WD options. And these tractors are specifically designed for small and mid-sized farms, offering better torque, improved handling, and ease of use, all while keeping the price farmer friendly. But here is where it gets interesting. This isn't just a new product launch, it's a part of much larger transformation roadmap for FY26, where VST is expanding its rural distribution network, adding more product lines, and targeting 20 to 30% growth over the next few quarters, driven by favorable monsoon trends and a surge in demand for the small farm merchandisation. So, Mudit, what's your view on the FENTM launch and how it positions VST in the evolving agri machinery landscape?
Thanks, Sejal. What stood out for me is that VSC isn't trying to be everything for everyone. Instead, they are doubling down on their core strength, compact and efficient solutions for small landholders. The FENTM tractors bridge a major gap. They are powerful enough to handle heavy work but compact enough for fragmental Indian farmers. And globally, this segment is gaining traction too, especially in Southeast Asia, Africa, and even parts of the US. Speaking of which, the company is already planning to enter the US market by FY27 with a focus on compact tractor solutions. This export diversification is a big deal. It reduces domestic dependency and brings in forex revenues. And that's not all. VSA is working on a new category called Scope, which sits between traditional tillers and tractors. It's meant to address that in between farmer who wants more than a tiller but can't afford a full tractor. What's clever is that this line will be built using their existing manufacturing capacity, meaning low capex but high scalability. But Sejal, what do the FY25 financials say? Is VST ready to fund and support all these initiatives?
So that FY25 was a mixed bag, but it sets up a clean slate going forward. So let me break it down. Like revenue from operations rose 2.7% year on year, but the real highlight was the Q4 FY25, which saw revenues jump 37.6% sequentially, signaling a strong rebound after the mid-year softness. However, if we talk about the margin side, EBITDA dropped from 124 crores in FY24 to 111 crores in FY25, with margins contracting to 11.1% from 12.8%. And net profit also declined to 92.9 crores from 121 crores, with net margins tightening to 9%. And the main drag came in Q3 FY25, where profits nosedived to just 1.2 crores, most likely due to weak demand and inventory issues. But the sharp recovery in Q4 suggests that the worst is over now. So now, Mudit, given the margin pressure and the need for innovation, how is VST thinking about the next leap, especially on the electrification and the global scale front?
Okay, that's where the things get really exciting. VST is now investing in electric power tillers and electric weeders, aimed initially at the Indian market, but they're also eyeing exports to Europe and other regions soon after the launch. This aligns perfectly with global demand for lower esteem battery powered farm tools in urban farming and horticulture. The beauty here is timing. With EV momentum picking up in agri-tech and global subsidies supporting green farming, VST is entering at just the right moment. Add to this core line, which will likely to create a whole new mid-range category, and you've got a company that's not just reacting to demand but shaping it. And importantly, they are not going asset heavy. Instead, they are leveraging existing infra, focusing on smart capex and modular product platforms. And actually, you know what this actually does? That keeps ROCE healthy and margins in check. And as long as they manage working capital well and don't overextend. So yes, while FY25 had margin hiccups, I think FY26 or FY27 could be transformational, especially if the US expansion and electrifications go as planned.
Okay, thanks a lot, Mudit. That really helped us to understand the direction both these companies are moving in. So now let's take a quick look at how some of our previous picks have performed. Yatharth Hospital and Trauma Care Services Limited. We picked this up at 630.1 and it's now at 657, giving a return of 4.3%. Quality Power Electrical Equipments Limited from 720.8 to 758, that's a 5.2% gain. Then Bajel Projects Limited, this one saw a dip from 246.9 to 237, which is a 4% decline. Next we have is Car Trade Tech Limited. We picked this up at 1698.6. It's now at 2248, giving a solid return of 32.3%. Galway Technical Fibers Limited, it moved from 912 to 887.3, delivering a minus 2.7% decline. So overall, a pretty good mix of gains, and we'll continue to monitor all these companies closely to see how they shape up in the coming quarters. Now, here is the QR through which you can access all these previous picks which we covered recently. Now, let's move to the summary of today's company which we included in today's Noisemaker.
Here we can see the integration of the new
First,
flux
we have
capacitor
AXISCADES
design.
Technologies Limited, the company's wholly owned subsidiary, AXISCADES Aerospace Technologies
Agreed.
Pvt Limited.
Here we can see the integration of the new flux capacitor design. Here we can see the integration of the new flux capacitor design.
And VST Tillers Tractors Ltd, the company has launched the FENTM
Agreed.
Tractor Series.
Here we can see the integration of the new flux capacitor design.
Looks efficient.
So that's it for today's edition of Noisemaker, and if you find this breakout helpful, you can scan the QR code to read the full report, and we'll be back soon with more simple market updates. Until then, stay curious, stay ahead and stay informed.